You got straight A's. You read the books. You understood compound interest before most people knew what a brokerage account was. And you're still broke. Or not broke, but not where you thought you'd be. Not even close. Here's the part nobody tells you. Intelligence and financial success have almost zero correlation. And I don't mean that as motivation. I mean that as a warning. Because the people who get hurt the worst by money aren't the ones who didn't understand it. They're the ones who thought they did. This video is going to make you uncomfortable. Because somewhere in the next 10 minutes, you're going to recognize yourself. You're going to see a decision you made, maybe recently, and realize it wasn't smart. It was a trap. And the trap was built specifically for people like you. Stay with me, because by the end, you won't trust your gut on money anymore. And that's going to be the thing that finally changes everything. Let's start with something that should shake you. Researchers studied financial decision-making across income levels, education levels, and IQ scores. And what they found was almost insulting. Highly educated people, doctors, lawyers, engineers, PhDs, fall for financial traps at roughly the same rate as everyone else. Same rate, not a little worse, not slightly better, the same. So what's happening? If intelligence isn't the problem, what is? The answer is this. The traps aren't designed to fool stupidity. They're designed to fool confidence. And the smarter you are, the more confident you are. And more confident you are, the harder you fall. There are 5 specific cognitive biases that hit smart people the hardest. 5 mental shortcuts that feel like wisdom but function like poison. And once you see them, you can't unsee them. Let's go through each one. Bias number 1, overconfidence. This is the big one, the one that starts everything. You've been right before. A lot. Maybe more than most people around you. You solved the hard problems at school. You got the job others didn't. You figured things out. So when you look at the stock market, when you read an earnings report, or watch a sector trending, or hear about a company everyone's excited about, something happens in your brain. A quiet, familiar feeling. The feeling that says, I see this. I understand this. I've got it. And that feeling is lying to you. Overconfidence in finance doesn't look like arrogance. It looks like reasonable conviction. It looks like a well-thought-out position. It looks like research. But underneath it, there's an assumption that your ability to analyze a situation means you can predict its outcome. You can't. Nobody can. And the data is brutal on this. Studies show that the more confident investors are in a trade, the worse their returns tend to be. Not better, worse. Because confidence increases position size, reduces hedging, and delays the moment you admit you were wrong. The market doesn't care how smart you are, and it doesn't care how much work you put into the analysis. Here's what overconfidence actually costs you in real life. You put too much into one stock because you did the research. You skip diversification because it feels like settling. You hold a losing position longer than you should because admitting the loss means admitting you were wrong. And being wrong is the one thing smart people are least prepared to handle. But overconfidence is just the beginning, because the second bias is what keeps you there. Bias number 2, confirmation bias. Once you've formed a belief, your brain becomes a lawyer arguing for it, not a scientist testing it. A lawyer, building the case. You decided this stock is undervalued. Now, every article you read that agrees with you feels like evidence. Every article that disagrees feels like someone who doesn't understand the full picture. You decided real estate is the only real investment. Now, every success story reinforces it. Every cautionary tale gets filed under those people made mistakes I wouldn't make. This is confirmation bias. And it's not a sign of low intelligence. It's what intelligence does when it's not carefully managed. Smart people are actually more vulnerable to confirmation bias than average, because they're better at finding arguments. They can construct elaborate justifications for almost any position they've already committed to. They can make bad logic sound airtight. The result? You stay in bad investments longer. You dismiss warning signs faster. You surround yourself, consciously or unconsciously, with voices that confirm what you already believe. And by the time reality catches up, you've lost time, money, or both. Now here's where it gets really interesting. Because the third bias doesn't just affect how you think. It affects how you plan. Bias number 3, the planning fallacy. You've done this. Everyone has. You've told yourself, once I start making more money, I'll start investing. Once I pay off this credit card, I'll build an emergency fund. Once things settle down, I'll get serious about finances. And somehow, things never quite settle down. The planning fallacy is the tendency to underestimate how long things will take, how much they'll cost, and how many obstacles will appear between here and there. And for smart people, it's particularly dangerous because they plan beautifully. The spreadsheet looks immaculate. The timeline is logical. The assumptions feel reasonable. But life doesn't follow spreadsheets. And the future has a way of being exactly as complicated as the present, maybe more. What does this look like financially? It looks like the startup founder who raises a round based on projections they genuinely believe, then burns through capital twice as fast as planned. It looks like the person who thinks they'll aggressively save next year for the 15th year in a row. It looks like the home renovation budget that doubles. Every time. The planning fallacy isn't about being lazy or unrealistic. It's about the brain's inability to accurately simulate the future while fully accounting for friction. And the fix isn't to plan better. It's to plan differently. We'll get to that. But first, the fourth bias. This one is about what you can't make yourself do, even when you know you should. Bias number 4, loss aversion. Losing $100 feels roughly twice as bad as gaining $100 feels good. That's not a metaphor. That's the actual psychological ratio researchers found. 2 to 1. Pain outweighs pleasure by a factor of 2. Now apply that to money decisions. You have a stock that's down 40%. Every rational part of you knows the thesis is broken. The fundamentals changed. The market has moved on. But selling that stock means locking in the loss, making it real. And some part of your brain refuses. So you hold. And it drops further, and you hold more, because now the loss is even bigger, and selling feels even more final. This is loss aversion, and smart people suffer from it as badly as anyone, often worse, because they have a story, a reason they bought in the first place, and abandoning that reason feels like admitting intellectual defeat, not just financial loss. Loss aversion also works the other way. It makes you too cautious with money sitting in cash. You know the stock market returns an average of 7 to 10% annually, adjusted for inflation. You know keeping cash in a savings account is slowly losing value in real terms. But the fear of seeing your investments go down, even temporarily, keeps you on the sidelines. And on the sidelines, years pass. Quietly. Expensively. Now, the fifth bias. Save this one, because it might be the most seductive trap of all. Bias number 5, the illusion of control. You research before you invest. You diversify. You set stop losses. You watch the news. You follow the right analysts. You do everything right. And you feel, in some deep part of your brain, that because you're doing all of this, you have some control over the outcome. You don't. Markets are complex adaptive systems. They are shaped by millions of actors, geopolitical events, sentiment shifts, algorithmic trades, and forces that no single person can fully model. The feeling that more information gives you more control is one of the most expensive illusions in finance. It's why active traders, smart, informed, diligent active traders, underperform passive index funds the majority of the time, even before fees. They're not underperforming because they're bad. They're underperforming because they believe their effort translates to control, and that belief costs them. Here's the hard truth. Control in finance is mostly an illusion. What you can actually control is your process, your behavior, and your time horizon, not the outcome. And this is exactly where we need to stop and flip the script entirely. Because here's what most finance videos get wrong about all of this. They tell you the problem is emotion. They tell you to be more disciplined, to feel less, to think more logically. That's not the antidote. That's another trap. The antidote isn't discipline. It isn't more information. It isn't becoming a better analyst. The antidote is architecture. What does that mean? It means building systems that remove your emotions from the equation entirely, not by suppressing them, but by making them irrelevant. Let me give you 3 frameworks that actually work. Framework 1. Automate the decision before the emotion shows up. Don't decide every month whether to invest. Set up automatic contributions. Fixed amount, fixed date, no decision required. The discipline is built into the system, not borrowed from your willpower in the moment. When the market drops 30% and everything feels terrifying, your automated investment still runs. Not because you were brave, because you removed the moment of choice. This single behavior, automatic, recurring investment, separates the long-term winners from everyone else more than almost anything else. Not because it's clever, because it's boring. And boring in finance is a superpower. Framework 2. Make your investing rules in advance, not in the moment. Before you buy anything, write down the exact conditions under which you will sell it. Not what you hope will happen, not what you think will happen. The specific conditions. Price target, thesis violation, time horizon. Then, when emotion is running hot, when the stock is surging and you want to hold forever, or crashing and you want to panic, you go back to what you wrote. You don't feel your way to a decision. You compare reality to your documented plan. Smart people resist this because it feels like removing judgment from the equation. But judgment is exactly what gets corrupted under pressure. Your plan, written in a calm moment, is smarter than your gut in a volatile one. Every time. Framework 3. Seek out the boring answer first. Before you make any financial decision, ask yourself, what would the most boring, conventional, low-excitement version of this decision look like? Max your retirement account before exploring individual stocks. Pay off high-interest debt before investing in anything. Hold a broad index fund for 20 years before try to beat the market. These answers feel unsatisfying. They feel beneath you if you're someone who prides themselves on being smart and driven and different. But here's what the data keeps showing over and over. The boring answer wins. Broad diversification beats stock picking. Time the market beats timing the market. Consistent behavior beats brilliant strategy. The smartest financial move is almost always the boring one. So here's where that leaves you. You are intelligent. That is not in question. But your intelligence, the very thing you've relied on your entire life to navigate hard problems, is not built for financial markets the way you think it is. Your brain evolved for a world where confidence was rewarded, where pattern recognition saved lives, where quick decisions were better than no decisions. Finance is a world where overconfidence is punished, where patterns are often noise, and where the best decision is often to do nothing. That's not a weakness. It's just a mismatch between the tool and the task. And once you see that, once you stop trusting your gut and start trusting your system, something shifts. You stop checking your portfolio every day. You stop reading financial news like it's going to give you an edge. You stop making exciting moves and start making boring ones. And slowly, quietly, over years, the results start to show up. Not because you got smarter about money, but because you got honest about the limits of smart. So here's the question I want to leave you with. Which bias do you recognize most in yourself? Because it's almost certainly not the one you're thinking of right now. Sit with that.